What if we told you that you could start building a property investment portfolio with minimal money down? Even if you don't have tens of thousands sitting in the bank for a deposit, it is possible to buy your first investment property in Australia with much less capital than you thought. Intrigued? Hello and welcome to today's video on how to invest in property with little to no money down under in Australia. Buying your first investment property can seem really daunting, especially when most people think you need to save up tens or hundreds of thousands for a deposit. But here's the good news. It is possible to break into Aussie real estate investing with much less money than you probably thought. Now don't get me wrong, we aren't going to be putting down $0 on a $500K apartment in Sydney or something, but with the right strategy and expertise on your side, you can get started in property for less than you imagined. In this video, we'll break down step by step how this works. So buckle up your seatbelts, folks. By the end of this video, you'll have a complete roadmap for getting started in Aussie property investing with little capital. And make sure to watch right to the end, because we have some incredibly valuable bonus tips that no other property guru is sharing about how to set yourself up for long-term success. No dodgy get-rich-quick schemes here, just practical steps anyone can take. Now before we dive in, make sure you subscribe and hit the notification bell so you don't miss out on any of our future videos. We're putting these together to cut through all the noise and complexity, giving you clear advice on building your wealth. Let's get into it. First things first, why invest in property at all? What's so good about it? Well, real estate has proven to be one of the most stable and consistent asset classes over decades. Data shows property values double every 7 to 10 years on average nationwide. That type of compound growth is phenomenal. Plus, good investment properties also give you cash flow from rental income that rises over time too. So it's like getting paid to own the property each week or month. Another major benefit is leverage. Banks are happy to lend 80 to 90% or more of the purchase price, allowing you to magnify your returns. Simply put, property lets you use other people's money to buy an asset almost certain to be worth considerably more down the track. Now, as with any investment, there are risks and downsides too. Property is not immune to short-term fluctuations and downturns in the market. It's also relatively illiquid compared to things like stocks and shares. You can't easily sell next week if you needed quick cash. But history shows that those who take a long-term, buy and hold approach tend to do very well over 10 to 20-year periods. And right now in Australia, property remains affordable relative to incomes in most capitals. Plus, we have strong population growth driving demand into the future. So for savvy investors focused on building true wealth for themselves or their families, not making a quick buck, Aussie real estate still looks attractive. Okay, so hopefully you're convinced on why property is worth considering. Let's look at how you can actually invest with low deposits. First option is using what's called lender's mortgage insurance, or LMI for short. Basically, if you don't have the traditional 20% or more deposit saved, LMI lets you borrow up to 95% or 97% of the property's value. So for a $500K apartment, for example, instead of needing to save at least $100K up front, your deposit could be as low as $15K or $20K. The catch is that LMI comes at an extra cost, usually baked into your loan repayments. We're talking anywhere from $5K to $30K plus dollars depending on the size of your loan. Now we know this sounds bad. Extra fees or charges are never fun. But don't see LMI as dead money. It's better to think of it as the price you pay to access equity growth and capital gains that would otherwise take you years longer to achieve. If structured right, we estimate most investors recoup the full LMI costs within 3 to 7 years through rising property value and rental income. And given most investment timeframes are 10 years plus, LMI can work out far cheaper over the long run than waiting to save a full 20% deposit. The key is making sure you have some financial buffer though. Investing with 5% down leaves you more exposed if, say, you lost your job or interest rates rose sharply. That's why we suggest a 10% deposit as a reasonable sweet spot when using LMI. Gives you enough skin in the game without overstretching yourself financially. Okay, option 2 for reducing your deposit is tapping into equity if you already own a property. Simply put, equity is the portion of the property value you already own, outright. For example, if your home is worth $700K and your outstanding mortgage is $400K, then your equity is $300K. Banks allow investors to access equity for deposits on additional purchases through cash-out refinancing or adding a line of credit facility. This strategy does come with some risks, like owing more overall and higher repayments. But when done prudently, it lets you scale up a portfolio quicker than otherwise saving deposits from scratch each time. Just remember, you'll still want positive cash flow on both properties after refinancing, and some buffer room for rising rates or other costs. Don't overextend yourself. Alright, so now you've got finance pre-approval and your deposit ready through LMI or equity. The fun part begins, actually finding and purchasing your first investment property. Hands down, this is the most crucial step to get right up front. Making a mistake here by buying the wrong type of property will cost you big time in the long run. First, you need to choose your location wisely, based on metrics like historical price growth, rental yields, future supply and demand forecasts, etc. This step alone burns many new investors. Secondly, you want to purchase below intrinsic value where possible. Easier said than done in hot markets, but pay attention to signs of overpaying like huge price premiums or bidding wars. This all probably sounds basic in theory, but finding areas and properties with genuine growth potential plus buying under value is seriously tricky. Stats show the vast majority of mom-and-pop property investors either buy inferior assets with poor fundamentals, or they pay too much chasing short-term capital gains that don't materialize. That's why having an expert buyer's agent on your side is almost essential nowadays. Qualified agents have access to proprietary research, plus databases of off-market deals you'd never find yourself. They also have invaluable local area knowledge and appraising experience, able to determine a property's true value far better than any newbie investor could. So whilst paying a buyer's agent does add upfront costs, their expertise shaves years off reaching your goals through purchasing superior properties. Consider it your best investment yet on day one. Okay, few key things to look for once you've got great areas and deals lined up. For houses, solid construction and bones will serve you best long-term. Avoid anything too quirky or dated needing major renos. For apartments or townhouses, check strata reports carefully. High owner-occupier rates and sufficient sinking funds are key. Stay clear of dodgy cladding. Always get a thorough building inspection done, even new off-the-plan stock. And review contracts closely. Never sign anything on an impulse. If this all sounds terribly complex for first-timers, don't stress. We've helped hundreds of investors step by step through their initial purchase over the years. Comment below, and we would love to answer your queries. Besides, no doubt finding and purchasing investment properties is a big job. But the work doesn't stop once you get the keys. First up is arranging your financing. Will you fix part of the loan amount to hedge against rising variable rates? What about offset accounts to maximize tax deductions? Good mortgage brokers can advise the best structure here, based on your personal scenario. Though we suggest starting mostly variable when rates are low, then progressively fixing portions, as rates inevitably rise over time. Next is insurance. Protections like building and contents coverage are a must. But also consider landlord insurance for loss of rent or malicious damage. Compared to major risks, premiums are cheap peace of mind. Okay, once you've locked in financing and insurance, it's time to find tenants and effectively manage your property. Arguably, the rental market is just as important as buying right initially. Great tenants, price happy days. Nightmare ones, not so much. Here are a few tips for attracting quality applicants. Price rent affordably. Extra $10 or $20 per week isn't worth void periods or high turnover costs in the long run. Present property nicely. Fresh paint, tidy garden, and clean carpets make huge impression. Have professional signboard and online listings. Clear, attractive marketing cuts. Time vacant. For managing once leased, rules of thumb are: conduct quarterly inspections to preserve condition. Build rapport through occasional contact but respect privacy. Stay on issues early before they become major dramas. Benchmark rents every 12 months. Don't lose touch with market rate. Keep accurate records of property income and expenses. Lastly, a great property manager can handle all this hassle for reasonable fees. We highly recommend this option for smoother running. Though if self-managing, at least use tenancy applications like rent.com.au that handle payments and documents digitally. So much easier. Okay, hopefully, you're now well on the way to being a successful property investor. But what's the best approach for selling one day? AKA your exit strategy. Most investors hold assets long-term to maximize compounding and tax efficiency, but periodically reviewing whether to sell still makes sense. Reasons you might consider offloading a property include struggling to manage ongoing costs, portfolio becoming unbalanced or undiversified, better reinvestment opportunities elsewhere, personal circumstances changing, renovation costs exceeding value gains. Often refinancing or equity withdrawal serves you better than selling though. Depends on specific numbers and scenarios. Ideally, you would revalue all properties every 2 to 3 years, then stress test different hold-sell options taking tax, buying costs, etc. into account. If selling still makes most sense, aim for unconditional offers or auctions over private treaty, and time listings for peak buyer demand periods when possible. Okay, final thing is how to use equity you've built towards next purchases rather than cashing out. As a rule, each primary place of residence should allow 1 or 2 investment properties to be added through tapping equity, but portfolio loan limits and positive cash flow put natural brakes on uncontrolled growth too. Stay disciplined with benchmarks like total debt, less than 80% combined property value, minimum 1.5x income coverage across all loans. Adhering to rules like these, savvy investors can comfortably scale to 5, even 10 plus properties over time without overextending. Just remember, quality over quantity always. No point chasing sky-high portfolio value if it means poor assets and constant financial stress. Stick with the proven methods we've shared today. Solid properties, bought below value, generating surplus cash flow. Do that repeatedly through tapping equity, and you'll be on the path to financial freedom before you know it. Well, that's everything you need to start investing in Aussie property with little or no money down. Before we wrap up, just a few final thoughts. This stuff isn't easy. Property investing requires work, education, and the right mindset. But armed with the financing strategies we covered today, you can get started with minimal capital. Be ready to play the long game. Don't measure success in months, but rather decades. The patience and discipline you develop will serve you well. And don't go it totally alone. Connect with the community, get skilled mentors in your corner, and don't be afraid to pay for expert help. They can shortcut the learning curve. If you can commit to ongoing learning while taking decisive action, your future self will thank you. Even small steps today put you further ahead than if you did nothing. Alright, that's a wrap. Thank you so much for watching. Please hit that like button if you got value from this video and want more content on building wealth through Aussie real estate. Consider subscribing and turning on notifications so you never miss the latest videos.